Welcome to our third video, our webinar in the I Thought I Was Covered for That insurance series. I'm Liz Higgins. I'm an extension associate with the Eastern New York Commercial Hort team. And today is going to be sort of a potpourri of talking about sort of federal programs that operate either as insurance or disaster coverage that I'm hoping that to make you more aware of and sort of give you some strategies for thinking about coverage, or working with USDA or the National Flood Insurance Program or something for coverage. Because a lot of times what they cover are things that are exempted by or really expensive to cover through private insurance options. And so anyway, with that, I'm going to start the presentation. Like usual, if you have questions. So part of the reason why this is important is a lot of times, when we're thinking about disasters, whether it's floods, hurricanes, droughts, we think that there will be, a federal disaster assistance. FEMA will come in, USDA will come in, Small Business Administration will come in and help us. But most disaster assistance to businesses is really in the form of low interest loans. And so that, while that can be very helpful, that's not necessarily going to make you whole if you've had a major loss and now you're taking on a ton of debt. So, and also that disaster assistance, can be, dependent on the scale of the disaster. So if something happens to your farm, may say you get a microburst or a hailstorm and it only affects you, that might not trigger a disaster, a state disaster, a federal disaster where, extra assistance would be available. And so at that point, what you would be relying on, to support your business would be, insurance, whether it's flood insurance or crop insurance or other or NAP or some type of insurance. And so that's why I want to make sure that, you all are sort of aware of, where there may be gaps in other coverage and what might be available. So first, do you even need coverage and how much? We've gone over this in other webinars, but, you really first, before you buy any insurance, you really want to try to have a sense of what your risks are. Are you carrying a lot of debt such that taking on more debt in the event of a disaster or would really likely put you out of business? Or does your lender require you to have insurance? What is the location of your farm? Are you in a floodplain? Are you in a frost pocket? Do you have droughty soils? Are you reliant on a specific crop for profitability? And if that crop fails, you're unable to, pay your bills that year. And so it's really high risk. Is there a concern about an emerging pest or disease for a key crop that is very difficult to, sort of protect yourself from using, recommended management strategies? Are there certain, maybe pesticides you are using that have recently become unregistered and there really aren't good alternatives at this point in time? Have weeds become really resistant? Are there problems like that? And then what are your other available sources of income and revenue? So it could be that you have, farming is just one of many other things that you're doing. And so if you have a failure in one area, you have enough income coming in such that insurance is less important. But if agriculture is your primary source of income or revenue for your family, and sort of to pay your bills, then, you're at a higher level of risk, should you have a crop failure or some type of disaster on your farm. So the other question is, what does coverage cost, right? So how expensive is it to insure it? If insurance is too expensive, you're going to be looking also at maybe at mitigation strategies. How much benefit will the coverage be likely to get you compared to other alternatives, whether it's self-insurance, a line of credit, other employment? And does that coverage protect you from either a devastating rare loss or a frequent loss at an affordable rate? So can you, is what you're paying reasonable given the likelihood that you're likely to receive a payment from it? And these are all things that you'll want to consider. But, you can only really consider those if you're actually informed about what the coverage will cost, right? And what your options are. So, federal disaster insurance for a farm business, these are the different types of programs that I'm going to be looking at today. The National Flood Insurance Program, the Federal Crop Insurance Program, and then USDA FSA disaster programs with an emphasis on NAP, the non-insured agricultural program, because it functions like insurance, but also touch on some of the other disaster programs. And they're all the same in the sense that they cover events and situations that the private insurance markets generally either exclude, or it's very expensive to get coverage because the risks, or the possible costs if the event occurs are so high that very few insurance agents, companies want to take on that risk. They provide subsidized policies to make coverage affordable. So they really want to encourage, whether it's homeowners or insurance, crop farmers to buy that insurance and to have some skin in the game. Coverage is often required in order to get other federal benefits. You can't get a federally backed mortgage if you're in a floodplain unless you buy flood insurance. You can't, some federal farm loans require you to have federal crop insurance. And then if you've gotten a disaster payment, they often require you to either get flood insurance or crop insurance. And then coverage, as I said, it's required. Once you receive a federal disaster payment, you're often required to enroll in an insurance program in order to be eligible in the future to receive a disaster payment. So they want to say, like, if you've had a disaster, then it's more clear that you might actually, benefit from the insurance coverage. There are some ways in which they're different. Some policies are sold by private insurance agents, so even though these are public programs, you would go to, a traditional private insurance agent to buy them, and that would be the National Flood Insurance Program and Federal Crop Insurance. And then some are provided by USDA FSA, so the FSA disaster programs you would go straight to FSA for. Some are true insurance products where those premiums are based on actuarial risk. And that once again would be the flood insurance program and the crop insurance program. So even though there may be some subsidies to make them more affordable, there is an underlying, sort of a sense, sort of accounting for real risk in developing what the premiums are. And then others are really just payments. They may be based on a formula or something, but they don't have that same level of actuarial sort of heft, and that would be a lot of the FSA programs. And then that's why they're called disaster programs and not insurance programs, because they're not really necessarily fully accounting for the full risk. And then some programs are geographically limited, while others are available nationwide. And then some programs are only available after declared disasters. But the FSA programs, there might have to be a disaster before they're triggered. The federal crop insurance program, some of the insurance policy types are only available in certain counties, so they're not necessarily nationwide. And then there are even some communities that are not able to participate in the flood insurance program because those communities don't, sort of enforce their laws around floodplain management and stuff. So that's a really rare situation, but but it's not necessarily available everywhere. So I'm going to start with the flood insurance program. I'm not going to go into too much depth with this, but this is a program that I think a lot of times when we talk about farm insurance, we don't talk about this. And yet, it's certainly where I work, and, flooding is, an increasing problem. And flood insurance, floods are not included, especially for structures, in a lot of, they're excluded from a lot of other types of policies. And so if you're not covered by flood insurance, and there is a flood, you are basically SOL, right? So, so homes and businesses in high risk flood areas, are required, if they're backed by the government, are required to have flood insurance. And those high risk areas, I'll show you what a FEMA maps looks like, but it's areas where, they have mapped that there is a high probability of flooding. And I do want to read, there are private market flood insurance policies, and certainly if you're finding that I'll talk about some of the issues with flood insurance, but, so if your situation is such that you may need like higher levels of coverage or more bundled coverage, those may be an option. But federal flood insurance sort of is the baseline. It's sold by private insurance agents, but those premiums are set by the federal government. So, it really shouldn't, your premium is going to be based on your situation. And it's sort of the location of your business, and its risk, sort of elevation over, for flooding, and the type of structure and the age of that structure. And so regardless of which insurance agent you go to, your premium for flood insurance shouldn't change. It's sort of determined at the federal level. So what you're buying, once again, if you buy flood insurance through an agent, is you're really buying service, and an insurance agent who will be responsive and, be helpful to you, but you're not necessarily buying you're not buying like cheaper coverage from somebody else. The two types of coverage that are offered are building coverage and contents coverage, and they're separate. So you buy either one or both. And commercial flood insurance protects a business's building and equipment, and the policies protect things like the foundation, the utilities, furniture, inventory. And each type of coverage, building and contents, can be covered up to $500,000 in flood damage. And I think for some farms, this is important to understand because, as we know, I work with farms that have equipment that's worth like well over $1 million, right? And yet, your contents limitation in federal flood insurance is $500,000. And so that would be some place where, you may want to see if you have, you probably wouldn't want to put that piece of equipment in a floodplain. But that would just be something to consider, right? That, you're because of this limitation, that they're not going to cover more than $500,000 for your contents, which would include your inventory, your infrastructure. You definitely want to be thoughtful about the location of infrastructure on a farm if you're planning a farm building. And the other thing is that a flood insurance policy is per building, per structure. And so if you've got multiple structures on your farm, you've got multiple, barns, multiple different houses and stuff, you're insuring each structure with its own policy. So each policy would then be up to $500,000, but it's one building per policy. There's no bundling of flood insurance in that way. There's a little bit of exception for like the home for like a garage, but that also is, it's sort of that's affiliated with that house, but that you wouldn't necessarily want to assume for a farm that outbuildings, barns and stuff are covered under the flood insurance policy you have for like your main house or whatever. So that's just something to be aware of also. So what is a flood? When we think of floods, we tend to think of like being next to a river or being next to the ocean. And this is where flood insurance, may be something to consider, even if you don't live right next to a river. The flood insurance program in FEMA defined flooding as 2 or more properties or acres of normally dry land that are partially or completely submerged by water from any event. It could be overflowing of inland or tidal water, so a river overflows, but it also can be unusual quick surface water runoff. And this is one that can actually be quite devastating. So you have a major rain event and water like runs down. I've seen this where, when I've lived in like a hillier area, water just like runs down the side of a mountain. And a lot of that, like when I worked during Hurricane Irene, a lot of the properties that were flooded were well away from the rivers, but water running down the side of a mountain, not even through a stream or anything, because of the really heavy rain, flooded properties. When the water hit the bottom, it all ponded up and flooded that property. So, so surface water runoff, especially when you have, really heavy rain events, buildings that are maybe lower where water would be likely to pond, from rain events. So those could be subject to a flood. Another thing that could be a flood is if a dam breaks, right? Or if somebody's got a pond or something on their property, like for water storage, and that breaks, and that water runs across to your neighbor, it happens to your neighbor, runs across your property, and floods you, that would be a flood. An example that's used in the homeowner situation would be your neighbor's swimming pool breaks and it floods your property. That would be under FEMA's definition of a flood. That would be considered flooding. It's two properties, normally dry land, submerged by water from unusual quick, runoff. And so, like your insurance, your typical homeowner's insurance at that point or your business insurance wouldn't cover that. On the other hand, if you have a storm, it's not water damage necessarily, because if you have a big storm and your roof blows off and your house gets a ton of water damage from wind or from that type of damage, that would tend to be covered, assuming that your policy covers that. But a flood would be, something that overflows water. And then collapse is thinking of land along a lake or other body. I think it's the surface water runoff that, tends to throw people off because they think they're safe. And then all of a sudden, you get this sort of inundation from some source, whether it's a storm or a breakage of a dam or something like that, or a swimming pool or a pond or whatever. And, they can at that point get flooded. So the other thing that happens is flood maps are, sort of one of the bases for rating how expensive your insurance policy is. And, in rural, they tend to be less accurate outside of studied areas. So if you're in the middle of a city and there's been a really recent FEMA study, those flood maps, are a much better sort of assessor of risk. You move out into rural areas, those FEMA maps, they do modeling. They don't necessarily go out and, look at the land as accurately. And so those maps may not act, so even though you may be in an area that the FEMA map says you're not really required to have flood insurance or you're a low risk of flooding, that may not, you need to look at how old is that map. So for example, this picture here, the map was, done as of 2009. They haven't done a study since then. That's, over 20 years. Rain patterns could have changed, something could have changed with road construction or building that makes an area more subject to flooding. And so, the risk, your insurance costs and your need to get insurance sort of for federal purposes, for mortgage purposes may be dependent on a flood map. But especially in rural areas, that flood map may really not fully capture your real risk. And so that's just something to be aware of when you're thinking about whether to get flood insurance or not. And I think that's, one of the things is that they said 32% of flood insurance claims in the past 10 years were from outside of high risk zones. So people who are not in these mapped high risk zones are over a third, about a third of the claims for flood insurance. So even though they didn't think they necessarily were required to get flood insurance or needed flood insurance, they did have a flooding event that resulted in a claim to the program. So the coverage, I touched on this, there's building coverage and there's content coverage, and they are decoupled from each other. Building coverage tends to be the building and those things that are permanently installed to the building, whether it's your electrical system, your furnace, your foundation, your fuel tanks, your water tanks, your solar energy equipment, and you can cover that up to $500,000. And then there's contents coverage, and that's also up to $500,000 of coverage, and that'll be your furniture, electronic equipment and machinery inside the building, carpeting, portable air conditioners, and then for a business, merchandise and raw materials held in storage for sale. So that would be, so if you've got coolers and there's, food in the coolers, if you've got a silo, grain bins or whatever, and you've insured them, grain in that grain bin would be contents coverage. But I think what's really important to understand with flood insurance are there things that it doesn't cover. And for farms, like it doesn't cover currency. So if you've got, like valuable papers or money is not covered. But livestock and growing crops is not covered by flood insurance. There are other programs that can, if there is a disaster, we'll have some of the FSA programs, and crop insurance would cover those. Cars and most self-propelled vehicles are not covered under flood insurance. Those tend to be covered under your vehicle policies. Personal property that you keep in a basement. So if property that is kept in basement areas are basically in general, most of the stuff down there, unless you've made mitigation and it's, you need to look at your policy, but generally if you've got a bunch of stuff stored in a basement and then it floods, that's unlikely to be covered by flood insurance. My parents found that out the hard way at one point. And then property outside of an insured building, and that would be like septic systems, bridges, fencing, wells, unless you maybe, in the case of fencing, there maybe is the possibility of an endorsement, but those are not covered by flood insurance. So if you've got a bridge and it wipes out during a flood, your flood insurance policy won't cover that. Septic systems, that's one that really, I have seen really affects people during a flood. That's not covered under flood insurance. And then financial losses from business interruption. That's a totally different type of insurance, and that's not covered under flood insurance also. So it's good to also to sort of think about where your risks are too when you're considering where you should cite things and what other types of insurance you may need. One thing to be aware of, and especially this is important for people who are in more rural areas or areas where the maps are not, as up to date, is this whole idea of an elevation certificate. And so one of the things that really factors into how much your insurance premium is what the elevation is of the first floor of the property to the flood level, the expected flood level. And so if you're at the flood, level, if you're 0 feet above the flood level, you don't get a discount. The higher you're above the mean flood level, the greater your discount is. And so one of the things that you can do if you're building a building is to get an elevation certificate that documents your building's elevation above the mean flood level, and that would then give you a discount on your flood insurance. And that discount can be quite, as you can see, can be quite considerable. If you're 8 feet above the flood damage risk, then that's a 41% discount on your flood insurance premium. And so that, so if you get flooded, you still get a payment, but your premiums every year will be lower. Getting an elevation certificate, one of the challenges in a rural area is it kind of can depend on your location. Because the way you need a surveyor to go out and have benchmarks in order sometimes to be able to get that elevation documented. So if you're in a really remote area with limited data, that could be more expensive. So you'd have to sort of weigh the discount of the premium compared to the certificate. But if your flood insurance is likely to be quite expensive, and you feel like, especially if you're dealing with older flood maps or less accurate flood maps, I've seen people successfully challenge even the base flood height by getting a surveying study done and showing that their property is actually higher above the flood level than than FEMA said that it was, and so it could be worth it, but it's important to note that is important in the sense that it can make a big difference in your costs of flood insurance. Then there are things just to be aware of, and this is sort of based on my experience in working with landowners after major flood events. These are things that are expensive and they're not insurable through the federal flood program, and they're also usually not covered through disaster recovery payments. So damages to private roads and culverts, Though that's totally going to be on the private road owners and the culvert owners. Public money won't cover that. Flood insurance won't cover that. So if you live on a private road and you've got culverts or whatever, making sure they're maintained, so that you're not likely to have a culvert back up and flood, and cause damage to your road. Making sure they're properly sized is important. And then with your, with the landowners on that private road, having some sense of like, like have we put money aside in case we have a flood in order to repair that road. Damage to private bridges. If you have a private bridge to access your property and it wipes out, that's totally on you. And I don't know of any insurance coverage for that. Certainly public money will not cover that. Damage to septic systems and wellheads, and then equipment not in a building. That would be another thing to be aware of. So if there a big storm event is coming, and and there's a major flood, put your put your equipment away, I guess would be my recommendation, and thinking about where you're going to house equipment, and so that it can be covered. And talk to your insurance agent about strategies for managing that. So one of the things I kept sort of touching on is like that flood insurance covers structures, right? And that is what it covers. It doesn't really cover land. And so if you do have a major disaster, especially a flood, the program that is the most likely to help you is the FSA Emergency Conservation Program. And that provides financial and technical assistance to farmers to repair and restore farmland that is affected by a natural disaster like a flood. So, I've seen after a flood, you can have like gravel all over your fields, you can have gullies, it can be just an absolute mess. And this is the program that helps farmers and ranchers implement measures to rehabilitate damaged land and restore it to agricultural production. It is limited once again to $500,000 per person or legal entity per disaster. So it's not unlimited. It's not, you're not going to get millions of dollars. There is a cap on that, and there would have to be a disaster that qualifies for that program. But it can cover like removing debris, grading and shaping or leveling land, restoring permanent fences, restoring conservation structures, and implementing emergency water conservation measures during a severe drought. It's also important to recognize that this provides cost share assistance. So they're not going to cover 100% of the cost. For most growers, it'd be 75% of the allowable cost of an approved conservation practice. And so you'd have to have a contract or an agreement with FSA about what you were going to do and what was covered. Funding is also for the most part reimbursable after you complete the project. So, except for a few limitations, you need to have a way of paying to do the work and then get reimbursed. And so that's something to sort of as part of your risk strategy to prepare for. So that is just something to be aware of. And then funding, the availability of these funds is subject to annual appropriations, and it's provided first come, first serve. And so, there is so how much money will be available, and, are you eligible for that? Depends on, can be dependent. So that you have insurance. This program, there have been years where, because the farm bill is held up or appropriations is held up, that money might not be there, like exactly when you need it. So you need to be able to be prepared to wait, and maybe that funding, you might be able to receive funding like a year later or something. It's not necessarily going to be there available instantly. So the first, so I already touched on this, but one recommendation is before a flood, do it today. Establish a line of credit, because like during a disaster, especially if it's a big disaster, that's going to be a very difficult time to get through to a bank and really have a conversation about them. And also you may not be in quite as good a position. Whereas if you're in a good position right now, establishing a line of credit at a good interest rate gives you more breathing room if you have a flood or you have a major disaster, in order to, be able to do things and then apply, and then receive cost share assistance or payments or insurance payments later. So once again, the availability of funding is dependent on the severity of loss and the availability of funding. It's not guaranteed. And then I would say the first thing, and I want to keep reiterating this, if you have a natural disaster on your farm, contact your local USDA FSA office, provide documentation. Definitely do that because that is what helps to trigger this into being a recognized federal disaster. And also then at that point you're on their list, like if a program is available, they know that you may need it, and it may influence what becomes available by understanding what the needs of the grower community is. Next question is, can the I'm assuming emergency program work on newly purchased land, i.e. flood damaged land being sold as is, assuming it was used for agriculture already? I would say probably not, because, you can talk to USDA, NRCS, or FSA, but I think if you're buying it in that condition, they are unlikely to give you a cost share to fix it at that point. But I think that would be, but I'm not the final word on that. So that would be a conversation for NRCS or FSA to see what is possible on the land that you're purchasing. Okay. So we've talked about flood insurance, but now I want to sort of move over to we said that crops are not insurable. So crops growing in the field are not insurable under the flood insurance program. So there are two basic crop insurance programs for farms. Federal crop insurance, which is through USDA RMA, and it's sold by private crop insurance agents. And there's two levels of federal crop insurance. There is what they call disaster coverage or catastrophic coverage, or it's often abbreviated as CAT, where the premium is 100% covered by USDA, and the grower pays an administration fee, which is right now $655 per county, and for that crop. So, and there's many, with federal crop insurance, there's many different policy coverage options, and it can be really confusing. Some are yield-based, some are revenue-based. And the policies are required by law in this program to be actuarially sound. So these are true insurance programs. So they figure out what the risk is. They come up with a premium that is actuarially based. And then the way they help growers is they then subsidize those premiums everywhere from 100% down to about 50% at different coverage levels. And I'll go through that. But that's how the government helps growers, is by subsidizing the cost of the insurance, by covering a portion of that premium. The other type of insurance is it's an annual admin fee for crop insurance. USDA NAP is the non-insured ag program, and this is for those crops that are not covered by a federal crop insurance program, except for a pilot program. If you're under one of the pilot programs, and whole farm revenue is an example of a pilot program, you can use NAP also. But in general, if federal crop insurance is available for the crop in your county, then you would use that. If it's not available, then you would use NAP. And so some growers actually use both programs. So they have federal crop insurance for the coverage for the crops where there is an insurance program, like apple. I work with a lot of apple growers, so apples would be covered. But if you're an apple grower and you also do blueberries are not covered in a lot of counties. I don't think they're covered in any county in New York. And so that would be covered by NAP if you wanted to insure your blueberries, or cover your blueberries. Basic NAP, it's very similar. They set NAP up to be sort of parallel to crop insurance. It provides really similar coverage to CAT, right? So it's a catastrophic program. A grower pays an admin fee, and that's $325 a crop. And I think it's to a maximum of maybe, $800 per county, and then $1,300 for multi-counties. And then you can buy up coverage for a payment that's similar to an insurance premium. It's formula based if you want higher levels of coverage beyond that catastrophic. Um, so we'll talk about the federal crop insurance program. There's many insurance products. There's some, I mostly work with specialty crops, fruit and vegetables. So there are policies and programs I'm not as familiar with, because most of the growers I work with don't use them. But it's a pretty comprehensive array of insurance products. It's sold by private insurance agents. Premium rates, it's very much like flood insurance, where premium rates are set by the federal government, and then insurance premiums are subsidized by the federal government. So when you choose an insurance agent for crop insurance, um, and so you're once again you're basing somebody, you're choosing an agent based on service and their responsiveness and their knowledge. You're not choosing an insurance agent to try to get the best price on crop insurance, because the price should be the same no matter which agent you go to. You're really choosing somebody who can recommend the insurance tool that's the best for you and your farm, and that makes the most sense. Um, and so I would say for maple trees, that would be maple would be covered most likely under the NAP program. I don't think there's crop insurance for maple trees, so that would be but I think maple trees might. I think there's a possibility that they're covered under the NAP program. And yes, if they are covered under NAP and there was a fire, that would be likely to provide coverage for you. So there are benefits to beginning farmers and veterans. These two categories get a higher subsidy level. So I think, so if the federal government ordinarily would subsidize insurance at, like, let's say 70% for the same price, they would be they would be subsidized at like 80%. So you get a higher subsidy. You're able, if you're a beginning farmer, to use the previous producer's production history, because one of the challenges when you're a beginning grower is that a lot of times your insurance payment and your coverage is based, until you have records, several years of records, you're just using county averages, and those may not be as favorable to you. County average yields, county average prices. And so if you buy a previous producer who's growing the exact same thing and they kept good records, that gives the insurance company some knowledge of what that land is capable of and what kind of production yields you'd be able to expect. And then there's one of the other benefits is higher substitute yield adjustment. So it allows you to, once again, there are tools within crop insurance that allow you to substitute, like higher, like your higher yield, drop some of your lower yields. And so they make that sort of choosing the better yields or more favorable yields easier for beginning farmers. And so it gives them some benefit that way, as far as, creating an insurance that sort of program policy that would be, sort of give them better coverage and maybe at a lower premium. So crop insurance generally is for losses, natural disaster based losses. So it's weather, fire, insects, diseases, wildlife damage, price decline. And generally what they consider is, like, it should be like what, if you're doing sort of what's normally recommended for a decent grower to do, you're using good farming practices, and then you still have, like a disease problem, maybe you have a pest that is very difficult to control with the tools that are available, but you're doing everything that, a reasonable farmer would be recommended to do, and you still have a loss, then you would be eligible for an insurance payment. So it doesn't cover, if you have losses because, you don't have enough labor, or you don't actually, you fail to manage your farm properly, you leave for vacation and you don't sort of have anybody weeding. So if you're not using good management practices and you don't have enough labor, or if some machinery fails and you don't have machinery, that would tend to not be an eligible loss for crop insurance. So they're not covering you for the most part. There may be some insurance. I know there are some insurance policies for that cover what do you call it, like greenhouse failures, stuff like that. So it's not that there's no tool for there, but you can't assume that because you couldn't get the harvester there on time, or your plow broke and your weeds got out of control, that's going to be an eligible reason for and you have losses because of that. Crop insurance probably won't cover that. Most USDA crop insurance plans cover a single crop at a time, and they cover it in a variety of different ways. They cover it based on yield losses, based on your yield history. They cover your revenue based on revenue history. They protect you to guarantee a certain yield. They might guarantee a certain revenue. They may, they may have, there's just a lot of different types of insurance products. One of the ones that I'm going to talk about a lot, because I think it's really useful for a lot of growers in New York, especially diversified growers, is whole farm revenue protection, because that is a policy that I think especially for people who are doing specialty crops or diversified farms, has a lot of, or who are mixed livestock and crop, whole farm revenue can cover losses based on revenue loss. The other thing to look at with crop insurance is there are different endorsements and options that, once you have a base plan, you can add. So, for example, if you've got an actual production history policy, you can add hurricane insurance protection on top of that. So there's no standalone hurricane protection policy, but it's an endorsement or an option on top of these others. And that will, so if you've got losses due to high wind, that can be an endorsement as so all of your corn falls down. You don't have a flood or anything. It all lodges. If you've got a wind endorsement and there were high winds and that caused that loss, you would then be eligible for crop insurance. They add an additional cost, but depending on what your risks are, if you've seen a lot of wind damage or stuff like that, or you're in an area with a lot of hurricanes, as we are down in the Hudson Valley, that might make sense depending on your farm situation. The key problem and challenge for crop insurance, federal crop insurance, is the availability of that insurance product. It varies. Because it's required to be actuarially sound, it really favors crops that have transparent markets and a lot of historic data. It's a lot easier to create an insurance product for something with a lot of data. If there's very little data, it's really hard to create an insurance product for it. So therefore, as a result, because there's fewer, people grow vegetables and fruit in a lot of different ways. If there's not as many acres of it, USDA doesn't collect as good data on it. People market it all different ways, at a lot of different price points. Coverage for specialty crops is a lot more thin, and the coverage does tend to focus on areas of concentrated production. So you see a lot more options for fruit and vegetable coverage in places like Florida, California, where you just have massive acres of fruits and vegetables grown, and people really specialize in acres and acres and acres and acres and acres, hundreds of acres of strawberries. They tend to want, that type of coverage. Whereas somebody growing an acre of strawberries, that's less, it's less, unless a lot of growers in that area want it, it's hard for USDA to justify the effort that goes into those studies. With that said, whole farm revenue and microfarm are available in every U.S. county and territory. And those programs, which are very similar, they cover most crops, and they can also include livestock. And then farmers can request individual coverage for their crop if there's a product that's available in another area. So a good example could be, blueberry coverage, or apple. There are counties in New York that are not covered for apples. But we do have a lot of counties in New York that do have apple insurance available. If you're in a county that doesn't have it available, you can request coverage under the apple program. You just have to get an insurance agent to write a policy for you. It can be a little bit more work to get that done, but if the crop, if you are a significant grower of a crop and you just happen to be outside of an area where that coverage is available, don't just throw up your hands. I mean, there is a way to see if you can have that coverage. And then also, if there is a product in another state that would make sense for you. You can also request that RMA, and you're interested in that insurance. Like there's a group of growers that would buy it if it was available, but it's not available in their state. You can request a RMA to look into making that program available in your state, maybe as a pilot at first. A good example of that is, Connecticut recently had got crop insurance coverage for fresh market tomatoes because there were several growers there that were, fairly sizable growers of tomatoes. And there is that coverage in New Jersey. And I think they were able to use that information from New Jersey and get enough information to then cover several counties in Connecticut where growers also wanted it. So if you see if there is a type of insurance that's not available in your county, but it does exist, there are mechanisms, to get that coverage in your county. You just have to want it bad enough. So you can request that expansion. The other thing you can do is USDA RMA has a cost estimator where you can put in your information from your farm and estimate what the cost of an insurance policy would be for you. So that can be something that you can play with if you kind of want to get a sense whether it makes sense before you track down an insurance agent. The one negative to this is that sometimes there are, like discounts if you've got like whole farm revenue and, and one of the single crops, or, there can be some synergies between different policies that might not be reflected in the cost estimator, but at least as a starting point, it's a useful tool. So like an example would be this fresh market tomato, and this would be the Connecticut data to get a sense of what, this is the yield, tons per acre, sort of the average yield assumed in that state. And the price for insurance would be $65 tons per acre. Coverage, you can cover up to 50, between 50% to 85% of your yields. And this would be the covered yield. So if you're covering 85% of your yield, you would receive an insurance payment after your average yields fall below 48 tons per acre. So you're guaranteeing that you're going to, at least 48 tons per acre. And so this is what this is how much, if you lost everything that the federal government would owe you, the insurance payment, and your annual premium would be $4,000. The subsidy for this is not that high. I think it's only like 50%, because you can see kind of where the break points are is where for, just like a 5% difference in insurance, you start to see a bigger gap between levels. And that's, sort of the lower levels of coverage tend to have higher levels of federal subsidies. So I guess I see, where do you think cut revenue in the micro program? These are ones where you're insuring your revenue. You're not insuring your yields. And so the whole farm revenue, this is the original program, it can cover up to $17 million in revenue. And then that's all of the, and you put in there all of the crops and livestock that you're producing. And then whole farm revenue micro covers up to $350,000 of revenue, or $400,000 if after your first year. And that whole farm revenue micro can also include some of the revenue from value-added revenue, jams and jellies, if you sell them through a direct market. Whereas whole farm revenue, the standard program, doesn't allow value-added revenue. It's just the revenue from crop production. And there's a lot less paperwork with whole farm revenue micro. It doesn't use per crop yield or price data. And diversification is automatically based on 3 commodities for the discount. And the premium then is based on an index for that county for a diversified farm. they do need 3 years of tax forms for you to be able to participate in this program. And then whole farm revenue, they actually do use commodity count for diversification discount. So the more commodities you have, the more of a discount you get from diversification, because they figured the more diversified you are, the less you are to have a major revenue loss because other crops will make up some of the difference. And you also do need yield and price data per crop because and that's based on third-party information or your own. I mean, and it can be your own records too if you keep good records, because they do they do factor in the risk of that crop, as a proportion of your overall market basket of crops. So if you are mostly growing some crops that are, more risky, then your whole farm revenue policy would be more expensive than if you're growing like 8 not very high risk crops. So that premium is based on the actual risk of the market basket of crops they're insuring. So if they're a mix of low risk crops, your premium could be lower, even than whole farm micro. If your mix is really high risk, your premium could be higher than the whole farm micro. And they need 5 years of tax forms for whole farm revenue in order to be able to look at your revenue over 5 years, 3 for beginning farmer and veteran farmers. So this is a program you can't, the first 3 years, you need 3 years of data. So if you can't participate in this program yet, a good place to start is by enrolling in NAP. And that way you could get coverage right away. And start building some of that price and yield information through the NAP, through participation in NAP, that could then carry over to the whole farm revenue and the whole farm micro program. So that is one of the limitations to this program, is because in order to be able to insure your revenue, you actually have to have a revenue track record. And so whereas NAP is based on yields, not based on revenue, and so they can insure you through NAP a lot more quickly. There's been some people have looked at whole farm revenue in the past. They have made some really significant improvements to this program, just even in the last few weeks, that if you've looked at it in the past, it might be worth looking at again. There's an additional premium subsidy for beginning farmers, so the subsidy is a lot higher. And then because, going back to Kathleen's point, since you can't participate until after the 3rd year, they've also for most crop insurance programs, NAP is only, the beginning farmers is only for 5 years. For whole farm revenue, you're counted as a beginning farmer for 10 years, and you get that premium subsidy for 10 years rather than just for 5. And they also waive that $30 admin fee for beginning and veteran farmers. So that's an improvement. But the other big thing is that now they allow you to insure up to 90% of your revenue. So you're basically, if you insured that much of your revenue, once you get below a 10% loss, revenue loss, you would then be qualified for an insurance payment. And so one of the things I saw when I was doing research on crop insurance is that, on either end of the insurance, at the CAT level where, it's catastrophic, the payments are really low, and you only get a payment if you have a major disaster, growers still tended to end up ahead because they paid very little in, but if they had a major disaster, they got a premium because it was highly subsidized. And then they also ended up better off on the higher end, sort of above 70%, because most of the time, most of the losses for farms are not catastrophic. They tend to be like a 20% revenue loss, or, a really bad situation for a lot of farmers would be a 30% revenue loss. And it was rare to really, frequently go below that. And so if you insure at a higher level, you're more likely to receive a payment. And so you're more likely to sort of see, be made whole by insurance. So, and the other thing, so the coverage levels have gone up. It used to be that you were only covered, I think, up to 80%, maybe 85% if you were a beginning farmer. Now you can get covered up to 90% of your revenue. And then you're also subsidized now all the way up to the 90% level. It used to be that once you got above, I think, 80 or 85%, there was no federal subsidy. So the premiums were very expensive. And now you can see like up to 80%, 71% of the premium is covered by the federal government. Farmers are only paying for 29% of the premium cost. And so that's a, definitely, if you've looked at the program before. The other thing is you can use this whole farm revenue with NAP. So, because in some situations, say you have a major yield loss, but like prices stay high, you might not see a whole farm revenue payment. But if you have NAP, which is based on yield loss, not on revenue loss, you would receive a payment. You can actually use both programs at the same time. And they also changed it recently. So it used to be that if let's say you had NAP also, and you got a payment, that counted as revenue, which would then make you not eligible for whole farm revenue, or it could make it so that it canceled out that benefit. Now NAP payments are not included as revenue for towards your whole farm revenue when considering a loss. So that allows you then, if you have a loss and so your revenue goes down, your NAP payment is not filling in that gap anymore, unless it's a huge NAP payment such that you would be making more money than you actually, you're above your, if you've only insured yourself through whole farm revenue to 80%, you would get that maximum. If you got NAP in addition, you shouldn't end up ahead of where you would have been with whole farm revenue, but they won't make it so that you're below what you would have gotten. So, and then finally, the more diversification you are, the lower your premium is. And I'll show you an example of that in just a minute. So this is microloan. So I've just did 5 years of crop revenue. It automatically assumes 3 crops. So I've got a grower. They had 5 years of data. They're a pretty small grower. So they have $65,000 in revenue. You can see that the NAP premium in Ulster County, at the 50% revenue level, it's $650, and that would cover up to $32,000 in revenue. So that your revenue is not, you're guaranteeing when you buy this insurance that you're not going to have less than $32,500 in revenue. When if you cover yourself to the 90%, you're guaranteeing that you're not going to have less than $58,500 in revenue. That's the liability. And then you're paying for that, you would be paying $3,887. One thing, and this is where I want to point out, is that you can see that between 85 and 80%, there's a pretty big gap, much bigger than between 90 to 85 or between 75 to 80, because right here, this is subsidized, the 85% is subsidized at 56%, and the 80% is subsidized at 71%. So this would be, like if you were trying to decide, and I think 75% is also subsidized at 71. I would say as a rule of thumb, you always are better off insuring at the break point of the subsidy level. So I would, if I had to choose between 75 and 80%, assuming I could afford that, I would choose the 80% because I'm much more likely to get a payment, but I'm only paying, I think, what is this, like $700 more? But I'm getting, more than $700 in sort of coverage for that. So the coverage, you're getting a lot more coverage for a relatively small jump, whereas to go from here to here, now you're not getting as big a coverage differential, but you're having a much higher insurance price differential. Whole farm revenue. So if you had, I just assumed tomatoes because it's a pretty common crop. In Ulster County, you can see the premiums are a lot higher. At 90% here, this premium for this grower, for micro, 90%, it's $3,000. For the whole farm revenue insurance, it's $6,000. So if I'm a grower and I'm trying to decide, and I'm growing tomatoes, I would go with the micro farm insurance program, like no doubt. I wouldn't do the whole farm revenue insurance because I'm under the income level and the premium cost for the micro farm insurance because they're assuming that I have three crops, even though I only have one crop. It's just a lot less expensive. But now I'm doing a whole farm revenue and I'm in the same amounts, but I've got five commodities, right? Tomatoes, cabbage, herbs, cut flowers. Now you can see at 90% the premium for whole farm revenue. So the standard program is $2,754 at that 90% coverage, 1,400. And when you put them side by side, you can see that whole farm revenue, if you've got more diversity and you can capture that, can be a lower premium than the micro farm. But if you've only got like one crop for whole farm revenue, you're definitely better off going with micro farm because it assumes three crops and it doesn't really consider whether or not those crops are really high risk or lower risk. So that's kind of some of the way to think about the difference between these options. I think any insurance says, so as long as if so basically if your income, your revenue is below $350,000, depending on what you're growing, you're really going to be deciding whether or not micro farm or whole farm revenue make more sense. And, micro farm is certainly going to be less paperwork than whole farm revenue. But whether or not micro farm is cheaper than whole farm revenue is going to depend on how many crops you're insuring or commodities, I should say, and how risky those commodities are. So the last program I really want to focus on is NAP. NAP, the Non-Insured Disaster Assistance Program. This is for those crops that aren't eligible for crop insurance. One thing is, people often complain that it's just too much paperwork, keeping records on all those crops. We have too many crops. You don't need to enroll every crop on your farm in NAP. You can pick a crop that is, likely to be riskier in general. So, especially to minimize your paperwork burden. Like crop insurance, basic NAP is disaster assistance. It's low cost, but it only covers major losses. You need more than 50, like CAT, you need more than a 50% loss of crop before the program makes a payment, and it's only based on 55% of the contract price. So this is really, truly disaster assistance. But it's cheap, right? Like to receive NAP, you just pay if you're going to get the catastrophic, it's $325 a crop or $825 per producer per county, or the maximum would be $1,950. But if you're a beginning farmer, a limited resource or socially disadvantaged, or a veteran farmer, basic NAP is free. So it's, this is where you would get started, and certainly the price is right, and it can help protect you. It can also, as going back to Kathleen's point, it can start to help you collect some of that data that you might need then to be able to roll over to whole farm revenue and make that process easier for you if whole farm revenue is, a more attractive option. The limitation is, there is your income, your adjusted gross income can't exceed $900,000, so it's no billionaires for NAP payments. And there are, a maximum of $125,000 per crop year per individual for catastrophic, or a maximum of $300,000 per crop year for buy-up coverage. So, and that's why, especially if you've got a more, even higher levels of revenue, crop insurance, the whole farm revenue, or, the single commodity programs could be more beneficial, if you're likely to have losses that are greater than $300,000. Your revenue is more like, from that crop is more like, several hundred thousand or something. That's not everybody, but that is, for some people, certainly a factor. So for example, if you're Joe's farm, this is just a NAP example, you got 10 acres of strawberries, and I just like to use tens because the math is easier. So your expected revenue is 10,000. Basic NAP will only pay if your yield falls below 5,000 pounds. So for every pound below 5,000 pounds, you get a payment. A disaster hits, you only harvest 100 1,000 pounds of strawberries. So your NAP payment would be 5,000 minus 1,000. It would be based on 4,000 pounds. And, and the market price is $10. You get 55% of that. Your NAP payment for this farm would be $22,000. So then they have what they call buy-up, and that's more like insurance. It covers 50 to 65% of the crop yield at 100% of the contract price. And that premium cost is based on a formula. It's not actuarially based, and the formula is your share of the crop times the number of eligible acres devoted to the crop times the approved yield per acre times the coverage level. So that's 50%, 60%, 65%. So one of those times that average market price, and that's determined by FSA, times that 5.25% premium fee. So that is how you would calculate what your premium would be. And so you can see that this guy gets, if you get NAP buy-up, this would be you can calculate for this same exact scenario. This is the formula at 50%, 55%, 60%, 65%. His premium would be $2,625, $288, $3,150, or $3,412. The same disaster hits, and then you can see that after having the buy-up payment, his NAP payment would then be $37,000 if he insured it at 50%, because now he's getting the full price. At 55%, it's $42,000. At 60%, he'd get $46,000, and at 65%, he'd get $51,000. But you have to remember, every year you're making these premium payments, whereas so you're getting more of a payment during that disaster. But with just even the NAP catastrophic, you were getting $22,000 under this scenario. So depending on what you need, really the way to look at NAP sometimes is, what do I need in order to, pay my bills and feel whole again, in order to keep going, based on, sort of making it such that I have enough revenue to sort of go forward. It doesn't, one complaint about NAP is the market price, right? So under whole farm revenue, you base it on your historic revenue. Whereas NAP sets market prices, and one complaint has been that the prices for crops are too low, resulting in payments that are too low. FSA really they have been adding organic prices and direct market prices to NAP. So I do think, depending on what you've received in the past, it could be improved compared to like what you've seen historically. This does vary by state and county. And so one thing with NAP is to ask your FSA office for the current prices, the market prices for the crops that you're thinking of insuring. And if they're too low, provide data to county or state offices, FSA offices, to challenge those prices, right? Because NAP, FSA is looking for data, and they need data in order to sort of move the needle on prices. And so by being able to provide documented prices, really showing that those payments are out of whack, that is one way to improve those payments. In conversations I've had, FSA, they do want to make the program better, and they do have some power, certainly at the state level and at the county level, to sort of help move that needle. So these would be an example, for strawberries, caneberries, and gooseberries, the market price for strawberries is, $268 a hundredweight, but there is an organic market price that's, $100 more than that. And then there is a direct market price also that's $100 more than that. So there are opportunities to, to get a better price. And that's based on giving information to FSA to sort of help improve those market prices. And that then makes, your NAP payment more likely to be something that is beneficial to you if you have a disaster. So the last thing I just want to touch on very quickly is FSA disaster programs. And I'm not going to go into tons of detail on this because there's just tons of them and they do change. I'm going to talk a little bit about supplemental disaster assistance. The disaster set-aside program, it defers FSA loan payments when there's a disaster. The emergency assistance for livestock, honeybees, and farm-raised fish is a payment based on the loss of percent of fair market value. Emergency conservation program is a cost share for getting farmland back into production. Emergency farm loan is an emergency farm loan. It's a low interest farm loan to sort of help get you going. Emergency forest restoration is a non-industrial private forest land recovery from natural disasters. That's a cost share program. Emergency livestock relief program and emergency relief program. These are all to help based on feed costs when there's been drought or other losses. I think wildfires also. And then the livestock forage disaster program is for losses for livestock raised on federal land. Indemnity program is a payment for livestock loss due to an eligible event. Milk loss is payments for dumped milk due to an eligible event. We've talked about NAP, on-stored payment for eligible commodities stored in an on-farm structure due to a natural disaster. So like recently there have been payments for this in the South due to hurricanes, crops that were lost. And then tree assistance is a cost share to replant or rehabilitate orchard trees, bushes, and vines that were damaged or destroyed. In general, you have to have a greater than 50% mortality rate. But the key point about these disaster programs is they tend to be based on declared disasters. So the eligibility for them depends on whether or not your farm is included in that disaster program. So if you have a disaster on your farm, notify USDA FSA, because that is one of the things that's sort of needed sometimes in order to get a disaster declared and for them to know what kind of losses growers are having. There's usually a delay, and it could be like 1 or more years from that loss to a payment. So these programs can be helpful, but they're not helpful if you need cash right now. And then programs change. So, so the program, when they see that there's a pattern or something, they may there are programs now that are giving money for losses that growers had back in 2023. So you want to keep in contact with USDA FSA. And you want to maintain good records, right? Sort of because you don't know, you have a loss, you get discouraged, and then 2 years later, there's a program to help you with that loss. Doesn't do you a lot of good if you don't have documentation that you had the loss. So keep records of communications you had with Extension, FSA, others about losses you had. Make copies of those emails and put them in a file. Make copies of records of the losses. Keep copies of the pictures. Keep just all the documentation you can. Hold on to it for several years because a program could come along later on that can help you. Right now, there is a disaster relief program, stage 2, and that provides payments to producers who suffered a revenue, quality, or production loss to crops, trees, bushes, or vines due to a disaster in 2023 or 2024. Going back to my point that, you can have the disaster a couple of years ago and now there's a payment. It covers losses that were not insured or where the level of coverage purchased wasn't high enough to provide a payment for the loss. The enrollment period for stage 2, it opened in November, it closes in April. And so if you had a loss, if you had a flood or, some disaster on your farm, whether it was, a flood or too much rainfall or a freeze, or hail or something, and either the loss wasn't big enough that it triggered an insurance payment, or you didn't have insurance, you actually could be eligible for a payment now. And so what this supplemental coverage does is it takes what you had for insurance and it basically acts as if you had purchased a higher level. And then if you didn't have insurance, if you weren't covered, it would assume that you'd had 70% of coverage, NAP coverage for that. So for example, if you were a berry farm and you lost 40% of your strawberry crop due to hail in 2024, so you lost it, you got nothing, and you didn't receive a disaster payment, if you were uninsured at all, now you would get, it would be as if you had 70% insurance. And so now that green area is what you would get for a payment. If you had NAP Basic, that wasn't low enough to get a payment, but now you would receive up to, as if you had 75% coverage. And if you had NAP Buy-Up, at 50%, now you would get as if you'd had 80% coverage. So these green areas are that area now where you're eligible for a payment for, based on losses that you had in the past. So my key points are document your losses. Always, if you have a loss, if you have a disaster, take dated pictures with reference guides, right? Like, so if you want to, like, if the water got to a certain level, putting a ruler next to that, showing where the mark of the floodwaters were, is really helpful to really show what the actual loss was, what the flood levels were, what the damage was. Keep good records. Contact first your insurance agent, assuming you have one, and then USDA FSA, your county office, and don't clean up before documenting the loss. Like always, you really want to make sure you have good records about what your loss was, and then talk to your insurance agent about, an FSA about what you should do and when. You want to keep reserve funds or a line of credit to carry you through until assistance arrives. Because the reality is that disaster payments, they don't just sort of instantly appear, right away. You do want to determine if there are mitigation strategies that will lower your insurance premiums. If you're building a farm, really be aware of elevations and stuff about where you site buildings, because that could lower your flood insurance premiums and certainly help keep you safer. Don't put equipment right in the middle of the floodway. Determine if there are, things like that. Consider options for insurance. Don't rely on hearsay. One of the things that frustrates me the most is I was at a program recently and I heard like somebody say crop insurance doesn't work for specialty crop farmers. It doesn't necessarily work for every farmer, but there are farmers that it works very well for. And so it's, it's your responsibility, I think, to determine, what makes sense for your farm. Don't just assume, some people may have very outdated information and be talking about a program that is very different today than it was 10 years ago. And then communicate with USDA, FSA, and commodity organizations. These are all, everything I've talked about today is a public program. And so where it's not working or where there are ways for it to be improved, if prices are not right, like the only way these programs get better is when people, provide better information to these agencies. Sometimes the low payment rates are, as much a function of the lack of data as they are, the agency not wanting to assist growers. So with that, if there are other questions, I think I see two. Are there any federally sponsored insurance that covers livestock bees in particular? I believe that ELAP program, if you have bee losses, it's not insurance, but it's a disaster program for major bee losses. I think that NAP covers honeybees also, but that would be something we can check out with FSA. Harvested contracted buckwheat crop did not meet requirement germination for purchase under contract term. Would NAP cover the loss for the non-purchased buckwheat crop? Yeah, I think if there are quality standards there, then NAP would be, you'd want to look at the policy, but I would say in general, if because of the growing season or whatever, the quality wasn't there such that you weren't able to sell it, then I think NAP could cover that. Whole farm revenue also definitely would cover under that situation too, based on based on quality loss, if it was something that was due to weather conditions or other sort of beyond your control situation.
Yeah, I just want to, well, Liz is talking, I want to underline that, acts of God kind of thing is all this covers. And so if it's an insect infestation or something, and even if it's a, biblical level locust or something, that's not it, because you should be able to control that. So, drought, rain, hail, that those kinds of things. Otherwise, it's not going to be covered. So, depending on what caused that germination issue, may or may not be covered.
Yeah. I mean, if it's like, for example, you had unseasonable heat, like a heat wave, and, and they determined, you contact FSA and they did determine that that was qualified as a disaster and you couldn't control it, then it would, it'd be likely to qualify. But if it was just sort of normal weather, you know, then that wouldn't qualify. Um, where would we find out more about how to mitigate flood risks for crops, barn, etc.? These are existing structures and fields in a zone 3 flood. Yeah, I would say that where I would start would be one would be to have a conversation with your local soil and water um, and USDA NRCS because there may be ways of, they're the ones that tend to have a lot of the sort of the conservation mitigation practices. So they may be able to work with you to look at your farm to reduce stormwater, runoff and to mitigate sort of the effect of a lot of flooding on your property. With the building itself, I think that you could talk to a flood insurance agent. They may be able to recommend somebody also like who does buildings. Because what you may be looking out for flooding, like in a barn or whatever, would be, the one of the strategies with flood mitigation in particular is that the goal is to sort of like have the water go through quickly and not sit there, right? So there may be ways of increasing flow or something such that, you may still get flooded, but the flood is like it goes through, doesn't sit, and gets out quickly. And so the actual damage is lower and, elevating utilities, elevating, sort of feed and stuff such that it's less likely to be damaged by the most likely type of flood. I think those are some, and if you do that type of mitigation, those would be likely, and you can document that, especially if you're working once again with your insurance agent, those types of things could be likely to lower your flood insurance premium. They do tend to have credits for mitigation practices. Because actually, where a lot of the damage with flooding, especially in structures, is when the water comes in and it stays. That's if it goes through relatively quickly, and especially if you have materials that are more resistant, and you're able to do some retrofitting, you can still have a flood, but not necessarily have like as high a cost of loss and stuff.